Welcome back to the deep dive. Okay, so if you're following the news at all, you know we're right in the middle of this massive AI-driven economic boom. Feels like every single day there's another billion-dollar investment announced, some new tech breakthrough. It really feels like we're all riding this huge, unstoppable wave. But let's take a step back. Let's unpack this a bit. The sources we've been digging into, they suggest that, beneath all the hype, there are some pretty serious structural risks building up. And these aren't just software risks. We're talking concrete, steel, power grids, and high finance. So our mission today on this deep dive is to really analyze the physical and the financial foundations of this AI boom. We want to figure out why a crash might actually be possible, and maybe more importantly, what that could look like for you, whether you're an investor or just working in the industry.
Yeah, and what's really striking, I think, is how different this feels from past tech booms. Because it's not just about code this time. The current moment, it's really defined by this colossal physical infrastructure build-out. I mean, happening incredibly fast. We're talking massive data centers, specialized chips everyone's scrambling for, and just a staggering demand for electricity. And that physical scale, well, it magnifies the momentum, sure, but it also ramps up the risk if things slow down.
Yeah.
It's much harder to just stop building a data center than it is to stop writing code.
Right. And the speed you mentioned, it's almost hard to believe. Some of the examples we found in the sources, they show whole landscapes changing in just months. Like, take New Carlisle, Indiana. There are these satellite images showing what was, productive farmland just a year ago now. It's being turned into these huge industrial parks just for data centers in less
Yeah.
than a year. It's like this incredibly aggressive grab for land, for labor, for resources, all driven by the need to, well, house and power these AI models.
And that physical footprint, it translates directly into just extreme resource demand. We're not talking about your standard office buildings here. We're seeing projections now that a single one of these AI campuses could need, get this, over 500 megawatts of power. Just to put that in perspective for you, that's like powering hundreds of thousands of typical American homes. All that energy just for one company's AI setup.
Wow. Hundreds of thousands of homes.
Yeah.
That's a massive strain on local grids, on resources. But okay, when we pivot to the money side, the financial commitment, it's just a staggering.
Oh, absolutely. The amount of money flowing in is, well, unprecedented. Global spending on AI is projected to hit something like US $375 billion just by the end of this year. And the trajectory suggests we could be looking at $500 billion a year being spent by 2026. The spending is so huge, so fast, that one estimate we saw suggested AI spending accounted for, well, it's a bit mind-blowing, 92% of all U.S. GDP growth in the first half of 2025.
92%. Honestly, when I first read that number, I thought it had to be a typo. How do we even make sense of that? Is the source material saying that growth is only this build-out spending? Or are we seeing real productivity gains already?
That's really the million-dollar question, isn't it? Or maybe the $500 billion question? The sources suggest that high GDP number is mostly driven by the spending itself. Buying the specialized chips, the actual construction of the data centers, investing in all that infrastructure. That all counts towards GDP. It's not necessarily driven yet by the big productivity gains that AI eventually promises. That part's still lagging behind the investment. And here's the so what. That ties back to the physical side. When your economy is leaning so heavily on building physical things, real estate, chips, cooling, power, whatever, the momentum feels massive, right? But if those assumptions about future revenue turn out to be wrong, or if something slows things down, maybe a supply chain hiccup, maybe energy constraints, maybe demand just doesn't materialize as expected, then the reversal can be incredibly sharp. And unlike a software company that can pivot quickly, you can't just easily stop these massive physical projects once they're rolling.
Yeah, that makes sense. And it brings us right to this kind of financial paradox that the sources highlight. Despite these truly gargantuan investments in the physical stuff we just talked about, the actual revenue and especially the profit coming out of generative AI, it's still surprisingly small. I mean, we see examples right at the very top. Look at OpenAI, one of the big names. Reportedly, they made about, US $4 billion last year. But in that same period, they apparently lost around US $5 billion. So spending way more than they brought in. And a lot of that spending is feeding that infrastructure beast we mentioned.
Exactly. That infrastructure cost is just relentless. And it's not just OpenAI. It's not generating proportional profit across the board yet either. We also saw data, I think it was McKinsey, reporting that something like nearly 80% of companies that actually put AI into practice, well, they found no significant impact on their bottom line. So companies are spending the money, but they're not seeing the measurable cost savings or the revenue increases that would, justify that spending. Not yet, anyway.
Yeah.
And layering on top of that problem is this risk of hyper-accelerated hardware obsolescence. The sources really stress this point. This isn't your standard Moore's law where things get a bit faster each year. AI runs on these super specialized chips, GPUs, TPUs, things like that. And the tech is moving so fast that these expensive chips might need replacing every 12 to 18 months because the models just keep demanding more power.
Wait, did you say 12 to 18 months? That's way faster than a typical server refresh cycle. So you're telling me that a multi-billion-dollar asset, like that massive data center complex in Indiana, could be filled with hardware that's basically financially outdated almost before the paint dries.
That's precisely the risk. You're pouring huge sums into building the physical shell, designed to hold specialized gear that has this incredibly short built-in expiration date. And what's more, each new generation of AI models, while more powerful, often shows diminishing marginal returns. The improvements aren't as revolutionary as the first big leap was, so you're potentially spending more and more money on infrastructure that goes obsolete faster and faster for maybe less groundbreaking results than before.
Okay, so that really paints a picture. It sounds like a classic bubble setup almost. You've got these steep, ongoing, accelerating costs tied to physical stuff, matched up against fundamentally uncertain future profits, and this incredibly rapid asset depreciation schedule. That feels precarious.
Right, which leads straight to the next big question. How is all this incredibly expensive, rapidly depreciating infrastructure actually being paid for, especially when the profits are still so uncertain? And this is where the sources reveal something really fascinating. There seems to be this pattern emerging designed to kind of shift the massive physical risk off the immediate books of the big tech companies themselves. It looks like the tech giants are partnering up heavily with private equity firms, essentially offloading the direct ownership and the debt. So instead of carrying the debt for building these huge centers, they sign these very long-term leases for data center capacity.
Exactly. And it's those construction commitments, those long-term lease agreements that then get packaged up. They're bundled into these complex financial products, securities. The debt obligations get sliced and diced into layers, they often call them tranches, and then sold off to investors all over the world.
Okay, but hold on. If the big tech firms aren't holding the debt directly, why should we worry about it spreading? Where does that risk actually land? And how could it jump beyond just the data center owner?
Well, because the whole structure, the value of those securities, it's all built on the assumption of continuous, reliable, high revenue coming from those data center leases for years and years to come. And this market we're talking about, the one private equity is targeting, just through 2028, it's estimated to be worth around US $800 billion. That's a huge amount of debt. When these securities are sold, the buyers, institutional investors like pension funds, insurance companies, maybe wealthy individuals, they're buying based on the promise that these data centers will always be valuable, always in demand. And one of the reports we looked at made a really stark comparison. It said this lowering of debt built on assuming constant growth in infrastructure value and demand. It's kind of reminiscent of how mortgage securitization worked before the 2008 crash. Remember that? The risk gets packaged, sliced thin, and spread so widely that if a significant chunk of these data center leases suddenly go bad, maybe the tech becomes obsolete even faster. Maybe a big AI company slows its spending. The failure doesn't stay contained. It hits those pension funds, those insurers holding the bonds.
That's how you get systemic risk, spreading far beyond Silicon Valley.
Okay, so we have this foundation, huge physical commitments, rapid obsolescence, and this layered leveraged debt structure. Given all that, the sources point to two kind of paradoxically different ways this whole thing could burst, both leading to pretty major disruption. Scenario is maybe the one we'd expect. Tech simply fails to deliver on the hype. So AI companies keep investing billions, but they just don't generate the massive profits everyone expects. Share prices tank, that debt starts coming due, the value of those data center leases plummets, and then that financial ripple effect we just talked about kicks in, spreading through those leveraged securities into the wider financial system. A sort of classic tech bubble burst, but with a physical infrastructure anchor dragging it down.
Right. But then there's scenario B, and this one is, frankly, the ironic and maybe even more unsettling possibility. What if the tech succeeds too well too quickly? Imagine generative AI actually does radically restructure the global economy, like overnight, automating countless jobs and entire industries much faster than society or the labor market can possibly adapt. The shockwaves from that mass unemployment, collapsing tax revenues, huge social instability, could trigger an economic and societal disruption just as severe, if not more so, than a purely financial crash. So it's like disruption either way, potentially. So for you listening to this, understanding the warning signs becomes really critical no matter which scenario plays out, or even if it's a mix of both. The sources suggest keeping an eye on 4 key signals. First, watch for clear drop in AI-related company earnings, even while their spending stays sky high. That's a red flag. Second, Look for actual defaults on debt or leases specifically tied to data center infrastructure. That's a sign that physical assets are under stress. Third, watch for contagion. Signs that the trouble is spreading from tech into the broader financial markets. Keep an eye on private equity funds, maybe even pension fund disclosures related to this kind of jet. And finally, fourth, monitor for hints of that hidden hardware obsolescence we talked about. If suddenly billions in data center gear gets written down as worthless, the debt structures built on that value could collapse fast.
Okay, so we've laid out the risks, the debt, the leverage, the physical costs. But it's also important to say the sources suggest this isn't exactly like the dot-com bubble back in 2000 just repeating itself. Why is the structure of this risk considered different this time around? What are the maybe mitigating factors?
Well, probably the biggest difference is the underlying financial strength of the main players. The really big tech companies, Microsoft, Alphabet, Meta, Amazon, they aren't like those fragile dot-com startups that were purely speculative. These giants still have incredibly profitable core businesses, cloud computing, advertising, e-commerce, and so on. That gives them a massive cushion. They can absorb big losses in their AI divisions and likely ride out downturns that would have wiped out older tech companies. And second, kind of paradoxically, the very fact that this boon is so infrastructure heavy provides a sort of break. These mega build-outs, once they're underway with contracts signed, labor hired, materials ordered, they're incredibly difficult and expensive to just slam the brakes on. That physical commitment creates a kind of momentum, maybe even a market floor for certain inputs that just didn't exist with purely software bubbles in the past.
That makes sense. And also, critically, unlike a lot of the dot-com era, where many business models were, let's be honest, pure vaporware, .ai tools today are already being used pretty widely, right? Businesses, individuals are using them now. That suggests there's real utility and momentum, even if the revenue hasn't fully caught up with the massive spending yet.
Precisely. So the key takeaway isn't that there's no risk, but that the risk is different. It's more complex this time. It's much more deeply tied into the physical, real economy because of its reliance on real estate, on power grids, on specialized manufacturing, global supply chains. So if or when disruption comes, it's likely to be messier, more multifaceted. It could spread through that financial leverage we discussed, but also through physical resource bottlenecks, not just a straightforward stock market correction.
Okay, so pulling this all together, for you listening, maybe you're an investor, maybe you're a professional working in or alongside this industry, the deep dive gives us some crucial pointers, helps assess where the real risks are, and maybe how to think about deploying capital or resources more intelligently. For investors specifically, the advice distilled from our stresses seems to be really cautious, especially when looking at companies showing that pattern of massive AI spending combined with low or even negative profit growth. You really have to dig deeper and ask, is this huge infrastructure build out actually supporting a viable, profitable business model down the line? Or is it mostly speculative spending just riding the wave of hype?
Yeah, and critically, you need to look beyond just tech stock prices themselves. Pay really close attention to that broader financial exposure. Look for signs of stress in private equity, in real estate financing vehicles, anything connected to data center debt or those lease-backed securities. That leverage point where the debt gets packaged and sold, that's likely where the early signs of financial contagion would appear if things start to wobble. And for professionals, for businesses actually using or implementing AI, the advice seems pretty clear too. If your company is investing in AI, you need a relentless focus on quantifiable bottom-line impact. Is it actually reducing costs? Is it demonstrably lifting revenue? Avoid just experimenting for experiment's sake without clear metrics. And you absolutely have to structure any investment understanding that rapid hardware and infrastructure obsolescence is basically baked into the model right now.
Right. You just can't assume that the very expensive setup you build today will still be a valuable cutting-edge asset in, say, 3 or 5 years. It might not be. And beyond the tech itself, any strategy needs to grapple with the real-world logistical constraints. The sheer power needed, the cooling infrastructure, the fragility of specialized supply chains, finding the skilled labor to build and maintain all this. It's a complex physical challenge on top of the financial one. #tag outro doll.
So to kind of wrap it all up, the AI surge is definitely real. The technological potential is immense, no doubt about that.
Yeah.
But the enormous physical infrastructure required, the unprecedented demands on energy, and these complex, highly leveraged financial structures built underneath it all. They're introducing some really profound systemic risks. The core tension, the big uncertainty, really boils down to that gap between the steep accelerating costs happening now and the still somewhat uncertain future returns.
Yeah, and that leads us to maybe one final provocative thought for you to mull over. We saw in the sources how places like New Carlisle, Indiana, are being physically transformed almost overnight, driven by this incredible thirst for energy. So the question isn't just if the money runs out or if the business models eventually fail to deliver profit. It's also, can the power grid, can our actual physical resources even sustain this incredibly aggressive rate of build out that we're seeing? What happens if we hit a physical limit, an energy limit, a resource limit before the financial reckoning even arrives? What does that physical ceiling mean for the timeline of this potential disruption? Something to think about until the next deep dive.